Welcome to this episode number 34 of Your Next Trade, called today Weekend Trading. So we saw last weekend that after the OPEX, that was the peak of the equity market, at least for the short term. We had a peak on the S&P literally when the S&P expired on the Friday at the open as of last week. So why a weekend trading? So if you've been on social media, if you've been following the news yesterday, mostly on Saturday, you've seen on Twitter many experts, macro experts, turning geopolitical experts and telling you what's going to be happening in Russia, if Putin is going to go away, and all those stories. And that tells you a lot about weekend trading or paper trading, where we're going to have a lot of so-called experts telling you how to trade, how to expose yourself. And on Monday morning, they have absolutely no idea what to do because they are not taking any position. So it doesn't take much of time to realize that it is absolutely pointless to keep on talking and be a specialist on something where you have no clue. It's much more interesting to be ready on the Monday and making sure that you're going to be a real trader and not a paper trader. So let's jump immediately into the year-to-date asset performances. We have seen a bit of coming down of the stocks from their recent highs, but overall the stocks for Europe, for US have been very strong year to date. 13% for the S&P, roughly close to 30% for the Nasdaq. Europe is still very strong. Japan as well, even if Japan gave a bit of performance at the end of the week. FX picture is still the same, where dollar has been hovering between minus 1%, 2%, and plus 2%. But what is interesting is we start to see clear weakness in the Japanese yen. Why? Because the Bank of Japan is still doing the same policy, and there is a clear chart that you could be doing, which is US 10 years versus the Japan 10 years and the correlation with the dollar yen. So that's something that I discussed last year. There is I think a 7 minutes video, so probably I should put it as a link at the end of this video, which explain clearly what is the correlation between the USD dollar the dollar yen and the carry trade. Crypto still very strong, 87% for the Bitcoin now on the year. So there has been talks now that BlackRock is calling for the SEC to give them a green light to do an ETF kind. It's a bit of a trust, but that's the same of an ETF, and obviously that will make to a certain extent crypto more legit, and with the hope that there's going to be more money going into that space. But I'm more interested in the week-to-date asset performances, looking at, as I said, stocks recently that made a high on Friday a week ago, and since then a kind of a VWAP order where the whole week, as we're going to see later, stocks have been coming down literally in a very organized manner, as if people started on Monday saying, okay, put me an order, a VWAP order for the next 5 days, next 5 sessions, and sell. And you can see the performance is more or less the same between the different markets. So strong correlation across those markets for stocks. A bit more volatility this week for currency, so a bit of spike in volatility. So that I think that is something to check, to follow for the next few weeks. Because the macro world is very much awake, and currencies are moving again. As I said, Bitcoin, Ethereum, the whole space doing very well on the hope that ETFs will be bringing new money. WTI still weak, copper still weak. That tells you a bit about, as I said, over the last 6 months of the weakness of the Chinese market. So looking at the year-to-date industries performance, so the picture is still the same. Left-hand side, regional banks. Right-hand side, semiconductors. You're going to have the S&P that is roughly here. And as you can see, the industries or sectors underperforming the S&P are much bigger than the ones that are outperforming, which tells you that the market has been driven again by very few names, very few sectors, and the market breadth is not that good. We are always trying as trader, as portfolio manager, to identify the leaders and the laggards. What has been very clear over the last 3 months, mostly since the lows of March, very few names have been driven the market. And if we want to see a turn, if we want to see a change in the overall market, this is where we need to be looking at, is if the leaders might turn. Week to date industry performance picture is the same. If you look at the S&P that is here, many sectors underperform. So it's a tough market in terms of winners versus losers. I mean, I know what people are going to say. Just keep with the winners, and the people that have managed to do that have been doing very well. But that tells you, in terms of risk management, that your concentration is getting more and more extreme. And with any strong or extreme positioning, you get obviously a risk of a strong reversion to the mean. Year-to-date sector performance and the week-to-date, I'm interested more into that one because we know the one on the left-hand side. So real estate struggling for the week, energy, but overall everything has been struggling except the healthcare that has been outperforming a bit. So pretty much a strong down week. Rates. So looking at the 10 years, looking at the 10 versus the 2, 10 years, flattish on the week, 374 in the US. So roughly the same as it was last week. Germany, actually, if you look at Europe, there has been a bit of yields coming down, bonds going up. Why? Because the European PMIs that came out on Friday were pretty weak. So there are some hope now that, hope, I don't know if that's the good term, but as the European economy is not that strong, that the ECB could be less hawkish. And this is why we've seen the moves in the yields, and that has explained as well just before why the euro from the end of the week, especially on Friday, was pretty weak, because the flash PMIs, which is a very good leading indicator, is telling you that Europe is not very strong, to say the least. What about the Fed funds rate? Picture is the same as of last week, not much of a change. Peak rate expected around November. These days we are standing at 5.07%. If you look at the peak rates, that's roughly 5.33. So that gives you another plus 25 bips or plus 0.25% from here. So the Fed roughly will do something probably in July, even if the market is not pricing that for the time being. So one rate, if you look at the dots, we are talking at 2 rate hikes, so we are getting closer to the end of this hiking cycle. What about the VIX? VIX, I mean, it's really the tough one, because you have some news, you get some dispersion in the market, and in the meantime the VIX is doing the same as before, so it's trading lower, roughly around 13%, and that tells you that either market participants are thinking that in the next 6 months all is going to be fine, or you get some product that are distorting volatility. If you've been trading before, that was the case in 2017 when we get some ETFs that were mostly sold, and many market participants, mostly from Asia, that were selling volatility every single day. These days, if you are trading the market every single day, and I'm not talking, this specialist on Twitter only trading the market on Saturdays and Sundays, you will recognize that there are probably some forces, not necessarily that natural, that are dumping the volatility, and there is a huge divergence between the feel, how healthy the market feels, and what the volatility is telling you, and that's true as well, probably because this new phenomena of 0 day to expiry, 1 day to expiry is disturbing, disturbing the overall volatility behavior. So let's jump into the technical analysis, starting with, as always, with the S&P. So that will be your daily chart here. As you see, we made a top that was on the expiry. We have been coming down like in a very organized manner. We are still around close to the 43.20, which is for the cash for the S&P. This is the color for JP Morgan, which is at the end of this month, which will be on Friday. So there is a market has been squeezing this 43.20 above, and now the forces are coming back into the 43.20. So the expiry has been doing the job. Nasdaq is giving you the same color. Interestingly, I think this is the picture to be looking at, which is the Russell, explained mostly by this one, which is the regional bank. So in terms of drivers, in terms of catalyst, in terms of what's going to happen next, I think the regional banks is still the same story. We've seen some headlines of Yellen saying there's going to be more concentration in the banks. I think it's very true as well that if you keep the rates as high as 5%, that is detrimental for the regional banks because they are experiencing outflows. So we will see more regional banks having some trouble. So to me, this is a space to be looking at. I don't think anything is solved, despite what people have been saying, saying, oh, look at March, between March and June, everything is fine. It's just not true. The market is very much driven by those very few names, okay? Those very few names, the Meta of this world, Amazon, and you can see the trend is still the same. So for the time being, despite the fact that we are down 2% from the recent highs, I don't think the trend has been broken from this strong rally. Same with Apple, as long as Apple is doing so well and performing that way, I don't think there is a big change. In Europe, this is a bit different. If you look at the Stock 600, now we are getting close to the recent lows. DAX has been struggling a bit. We have seen some headlines on Siemens Energy and some other companies coming with big warnings. So we have the earnings season starting in 3 weeks. But both in terms of macro and in terms of company specifics, you start to see some headlines not that great. There was some Lanxess, which is a Germany chemical. So if you believe into cycle, if you believe that, for instance, chemical is a good indicator of early cyclical, should I say. Lanxess made a massive profit warning, and more or less they tell you that what they were seeing a couple of months ago is completely out of the window now, out of the picture. So clearly in Europe the picture is different, and if you think about macro through the lenses of CL1 for WTI or even for copper, the picture is not that strong. We have been discussing that over and over the week. But there is a divergence between some macro indicators from what is the market breadth of the market and overall what some sectors have been doing. So euro dollar, this is for the day. So you see on Friday a bit of a weakish day, to say the least, because the macro through the leading indicators have been deteriorating. Dollar yen is still the same. So anyone that is telling me about yen being Japan being that strong, again, it's mostly about the dollar yen. There is as I said, I'm going to be putting the link of the dollar yen versus the yields. The correlation is just phenomenal. So as long as the yields in China are staying around, I'm talking the 10 years around 0.4%, and in the US we are talking 3.7, 3.8%. The carry trade is just too good, and that explained a lot of the dollar yen weakness. To a certain extent, obviously this is the same with, not to a certain extent, this is even more so. The dollar Turkish lira is the same phenomena on steroids. In terms of the moves, but I'm more interested in this dollar yen. So I didn't want to do too long for the technical analysis. I'm thinking about what has been happening for the week, starting with the S&P future. So as you can see, the trend is more or less the same day, same story. You sell, and you start the week around 44.50. and you end up the week at 43.80, but that gives you 1.5-2% for the week. Not a huge sell-off, just a very organized, in a very organized manner sell, which is, you can, it's probably some positioning, some delta, and mostly with the end of the month coming. Flash PMI, so this is the one that we experience. So flash PMI is at 50.3. That was for June. We are coming down very quickly from the descent level and getting closer to the recession level. It's not only those indicators. If you look at the city leading indicator, they will be giving you the same picture. So Europe, if you think about the world in terms of GDP, you get 15-20% of China that is struggling. You got 15-20% of Europe that is struggling. We got US 25% that is coming down a bit. So 50-60% that is struggling, and emerging market that are struggling. So overall, if you think that, if you want to believe that the world is doing very well in terms of macro, I think you should. It's time to look at it again. What did we have after this? So we had the option expiry. We got the Bank of England. So the Bank of England on Thursday decided to do 50 bips, 0.5% instead of 0.25%. So very aggressive because inflation in the UK is much higher than in the rest of the world for different reasons. Again, I'm still looking at the leaders. As I said, the FANG versus the rest of the market. I explained that over the last session, over the last episode, which is do a screening of the leaders and how they have been trading versus the market. What is the volume, flash PMIs, and the regional banks. So this is the picture for the regional banks. Look at the ETF, you do KRE, you look at how those different stocks have been trading, and as you can see, this is over the last 5 days. So there is a bit of stress coming into the KRE again. As we are not too close from the recent lows, we're still gonna have 10-15. We are 10-15% higher. The market is not panicking, but I can tell you that it could change very quickly, and very quickly we could have the headlines of look at the Fed balance sheet, look at who's looking for fresh money. So. Really a space, as I said, over the last couple of months to be looking, despite the market going higher. Catalyst going forward, it's mostly for the end of the week, where we're gonna have the PCE going into inflation, the personal income, European inflation, the Chinese PMI. This is the end of the month, and this is the end of the quarter because we are in June. So you might see a lot of rebalancing based on the pension funds and the 60-40, especially after those big moves. Keep in mind that on Friday, because this is the rebalancing of the repositioning of the JP Morgan color, you're gonna see probably in the last hour of Friday some funny moves. Okay, on the S&P, you could see 1-2% very quickly in the last 30 minutes to an hour. Why? Because, as I said, this is rebalancing. Keep in mind that the market over the last week or so on the way down has not been that liquid, so less and less volume on the way down. And keep in mind as well that we get the 4th of July coming, and that means we're going to have a long weekend, or the US are going to be taking a long weekend, and that will be even more detrimental for liquidity. We got Fed power on Wednesday and Thursday, and interesting earnings as well with Micron and Nike. So here I put the Nike recent moves. So the implied move for those earnings are so that will be on Thursday after the close, 7.8% versus recent move of 7.9%. So more or less, what does it tell you? There is no magic here. Is the implied move by the market is more or less by how much the Nike has been moving over the recent week. So don't think that people are just putting like and playing darts for implied move. It's based on some work. You can do exactly the same if you get Icon or some other products. I strongly advise you, if you are looking at a stock, to know by how much the stock is expected to move and by how much the stock has been moving in the past. So that's to be looking at historical volatility versus realized volatility. And why I'm looking at his earnings, because in the next 3 weeks, starting around mid-July, we get the earnings season starting, and that's obviously a big catalyst going forward after the big moves that we have on different stocks. Finally, looking at the S&P weekly straddle 1.1%, same as this week, so not much of a move. So this is it for me for the week. As I said, weekend trading, you're gonna see a lot of people, telling you over the weekend what they say about Russia, about Ukraine, and they are specialists. Don't waste your time. If you're really trading, I can tell you that you get a trading plan, but you're not going to be going through all those bullshit that you saw over the last 24 hours on Twitter. So again, it's a bit of a grumpy me in the early morning, but honestly, I find that hilarious when I see all those people pretending, and specialists, when you get a macro guy selling you that he's got a geopolitical team doing the work on Russia, and I'm like, okay, what's next? So this is it for me. If you get interest in trading, you get the 4x4 video series, you get I think someone that could be interesting for most of you, which is the trading community. There are some channels that are for free, and there are some other channels that are for more advanced traders. This is it for me for the week. Have a good day, and I'll see you maybe next week, but that's not 100% guaranteed. Bye bye.